4 companies, one night, and a question that determines what the next 2 years of your financial life look like tonight. April 29, 2026, Microsoft, Alphabet, Meta, and Amazon all report their quarterly earnings at the same time, and tomorrow Apple follows. 5 of the 7 most valuable companies on Earth, reporting in a 48-hour window. In the middle of a recession scare, an oil shock, and the most important debate in financial markets right now, do the numbers actually justify the spending? Because here's what you need to understand before I get into the results. These are not ordinary quarterly earnings reports. This is the first real accountability test for the single biggest capital allocations decision in the history of corporate America. Together, these 4 companies have committed to spending between $600 billion and $700 billion on AI infrastructure in 2026 alone, not across multiple years. This year, $600 to $700 billion on data centers, chips, and AI infrastructure. To put that number in context, the entire GDP of the Netherlands, one of the wealthiest countries in Europe, is about $1.1 trillion. These 4 companies are spending more than half of that on AI. In 1 year and for months, investors, analysts, and everyone else have been asking the same question. Is the revenue coming? Is the AI spending generating actual returns? Or is this the biggest collective bet in corporate history that might not pay off? Tonight, we got the first real answer. And here's what happened. Microsoft reach fill in. Microsoft reported actual revenue against analyst expectations of $81.4 billion. Azure, the cloud division that is the single most important indicator of whether AI is generating real enterprise revenue, grew actual percent against expectations of 37 to 38% if beat. This is the number that matters. Azure beating its expectations means enterprise customers are actually paying for AI infrastructure. They are not just experimenting with it. They are deploying it at scale, paying for compute, and expanding their usage. This is the first concrete signal that the spend is generating the return. IF miss or met. Azure growing at exactly the expected rate or below it after Microsoft has deployed over $100 billion. In infrastructure spending is a problem. It means the spending is running ahead of the revenue. The gap between what is going out and what is coming in is not closing at the rate the investment thesis requires. Fill in Alphabet reported revenue of actual revenue. Google Cloud, which grew 48% in Q4 2025 and was expected to accelerate further, came in at actual cloud growth percent if beat. Google Cloud accelerating past 48% growth is a signal that the enterprise AI market is expanding faster than expected. Alphabet has committed $175 to $185 billion in Capex this year. If cloud is accelerating, the spending is finding customers. The AI arms race is generating revenue. IF Imis. Pivotal Research had already projected Alphabet's free cash flow would plummet almost 90% this year, from $73 billion in 2025 to $8 billion in 2026 because of the Capex spending. If revenue is also disappointing, the free cash flow collapse becomes a serious concern rather than a temporary investment phase. Fill ein. Meta reported actual revenue against expectations of $55.56 billion. Zuckerberg has committed $115 to $135 billion in Capex this year, nearly double 2025 levels. The question is whether the ad revenue machine is generating enough cash to fund what Barclays analysts have already called somewhat shocking spending that pushes Meta toward negative free cash flow in 2027 and 2028. Lift strong revenue plus maintain aid Capex. Meta's ad business is the funding mechanism for the AI buildout. If ad revenue is strong, the spending is sustainable, at least in the short term. Zuckerberg's bet that AI-driven ad targeting pays for the infrastructure gets another quarter of credibility. Revenue weak or Capex raised again. Analysts at Barclays have already modeled negative free cash flow for Meta in 2027 and 2028. A revenue miss on top of continued Capex expansion accelerates that timeline. And a company burning through cash at that rate in this interest rate environment is running a risk profile that the stock price does not currently reflect. Amazon Rzeeks fill in. Amazon reported revenue of actual revenue against expectations of $177 billion. AWS, the AI infrastructure and cloud division, grew actual AWS growth percent against expectations of high 20s percentage growth. If AWS beats, AWS crossed a $15 billion annual AI revenue run rate in Q4. If Q1 growth accelerates, Andy Jassy's letter to shareholders, where he said, "We're not going to be conservative in how we play this," about the $200 billion Capex plan looks prescient. The infrastructure is finding customers at a rate that justifies the spending. IF AWS DISAP at pints. Amazon is spending $200 billion this year. That is more than 50% above 2025 levels. Morgan Stanley is already modeling negative free cash flow of almost $17 billion for Amazon in 2026. Bank of America sees a deficit of $28 billion. If AWS growth is slowing while spending is accelerating, the free cash flow picture gets significantly worse. And the bond market, which prices Amazon's debt, will notice. Now, let me step back and tell you what these results actually mean. Not for the companies. For you, because here is the thing that most financial media coverage of earnings season gets completely wrong. Earnings reports are not just about whether a company beat a number by 2 cents per share. In this specific moment, this specific earnings season, the results from these 4 companies are answering a question that determines the trajectory of the entire stock market for the next 12 to 24 months. Here is the question. Is the AI spending bubble already cracking, or is the revenue actually arriving? We covered in a previous video how the $5 trillion AI buildout is being funded, how the circular investment between NVIDIA, Microsoft, OpenAI, Google, and Meta creates the appearance of an ecosystem when it might be closer to a feedback loop. We covered how 95% of companies using generative AI report zero return on their investment. We covered how OpenAI is projecting $74 billion in operating losses in 2028 while simultaneously being valued at $800 billion. Tonight's earnings are the first moment where the companies at the center of all of that spending have to show their work, not their projections, not their narratives, their actual numbers. The actual revenue from the actual customers paying for the actual AI products, and the market is paying attention. In the 48 hours before these results, search interest in terms like Microsoft earnings. Meta results and AI revenue hit some of the highest levels of the year. The FOMC also made its rate decision today, holding rates steady between 3.5% and 3.75%, exactly as expected, with Powell watching the oil shock and the inflation data carefully before committing to any further cuts. So rates are on hold. The oil shock is still running. Recession probability is still sitting between 30% and 50%. And the companies that have been carrying the entire market on their backs for 3 years just showed us whether they deserve to keep carrying it. Market reaction. Fill in. The market's immediate reaction told its own story. After the results, S&P futures moved up-down. NASDAQ futures moved up-down. Microsoft shares moved up-down in after hours. Alphabet moved up-down. Meta moved up-down. Amazon moved up-down. If positive reaction, the initial reaction was positive. And if the numbers hold, if Azure's growth rate and Google Cloud's acceleration and Meta's ad revenue and AWS's expansion are sustaining the investment thesis, then the bull case for AI gets another quarter of credibility. The companies spending $700 billion this year on infrastructure might actually be right. And the people who have been patient with the AI story get rewarded for that patience. But I want to be careful here. One quarter of results does not resolve the fundamental tension. The spending is still running ahead of the revenue at a pace that requires the growth to accelerate consistently for years. One good quarter of Azure numbers doesn't change the OpenAI math. It doesn't change the 95% enterprise zero ROI data. It doesn't change the $143 billion in projected cumulative losses before profitability. It provides evidence that the revenue is moving in the right direction. It doesn't prove that the pace is fast enough. IF negative reaction disses the market didn't like what it saw. And a negative reaction to these specific results from the 4 companies that have been the engine of the bull market for 3 years is not a routine earnings miss. It is a signal. It is the market saying that the revenue is not arriving at the pace that $700 billion in annual spending requires. It is the first crack in the narrative that justified the most concentrated stock market rally in a generation. I am not saying this is 2000. I am not saying everything falls apart tomorrow. Markets are not that clean. But when the companies spending $700 billion a year on AI start missing the revenue targets that justify that spending, that is the kind of data point that changes the risk calculation for everything that follows. For valuations, for future spending decisions, for the patience of institutional investors who have been funding this build-out. Here is what I think you should actually take away from this regardless of how the numbers came in. First, earnings season is not the same as business results. The numbers you see in these reports are the first draft of the story, not the final version. Companies guide analysts. Analysts calibrate their expectations. And then companies beat those calibrated expectations by a carefully managed amount. The game of beating expectations is not the same as the game of generating the returns that justify a $700 billion spending commitment. Watch the trend over multiple quarters, not the single data point. Second, the AI monetization question is not resolved by one earnings season. What tonight's results tell us is whether the revenue is moving in the right direction. They do not tell us whether the pace is fast enough. That question won't be fully answered for another 2 to 3 years, and by then the market will have moved based on its best guess about the answer. Third, the macro environment has not changed. The Strait of Hormuz is still closed. Baker Hughes' CFO said this week that it may stay shut until the second half of 2026. Oil is still near $95. Inflation is still above target. The Fed is still on hold. Recession probability is still elevated. Whatever these companies reported tonight, those macroeconomic conditions are still the backdrop. And they matter as much as any quarterly earnings number. And fourth, and this is the thing that I want you to remember, regardless of which direction the market moves tomorrow. The $700 billion being spent this year on AI infrastructure is not being spent because these companies are certain it will pay off. It is being spent because they are terrified of what happens if they don't spend it and a competitor does. This is an arms race, and arms races are funded not by confidence, but by fear. That does not make the spending wrong. Arms races have produced transformative technologies before. But it does mean that the investment thesis for AI is not built on certainty. It is built on a bet that the technological capability will grow fast enough to justify the infrastructure being built ahead of it. And bets of this size, at this speed, funded by this much debt and this much Capex, have a wider range of outcomes than the stock prices currently imply. Tonite gave us one data point in a story that will take years to resolve. So here is where I want to hear from you. Based on what you just heard, do you think A, the results confirm the bull case and AI spending is generating enough real revenue to justify the build-out? B, the numbers are fine, but the pace still isn't fast enough to close the gap between spending and returns. Or C, tonight was the first sign that the narrative is starting to crack and the repricing hasn't happened yet. Drop your take in the comments because the market is going to have its own answer tomorrow morning, and I want to know where this audience lands before that opens.